perfect. Then we are going on with the second point of naked trading principle webinar. Just a short notice that the first webinar in this class, and it follow up to the main principles of static and dynamic levels. If you are keen to get familiar with these principles, please ask your account manager, and he will give you the access to the first webinar. Today we will be focusing on another part of naked trading. It's Elliott wave theory. First of all, we will know how to recognize wave patterns. Then we will learn how to distract impulse and correction setups. Next, we interpret waves upon current market action. And finally, we see how to use Elliott theory in putting exit levels for trades. Moreover, we will cover this topic on live charts, so you can see how it's implemented not only in theory, but on practice as well. I hope you enjoy it. This webinar is organized with broker Tickmill. Many thanks goes for the organizer. And while we are practicing our skills for the trading, a good reminder might be that the best way to learn something is actually by practicing it. A solution for the entry-level traders could be a classic or standard account brought by Tickmill, as it provides the following advantages, such as low spreads, no liquids, allowing all strategies, including hedging, scalping, and arbitrage, positive decision on slippage, secured accounts thanks to segregating funds on separate accounts, and full transparency without having conditions and charges with a small text. For the introduction, I choose for Walter Peters, PhD in finance. Focusing on indicators may be one of the primary reasons that some forex traders do not make money. Indicators can be confusing and helpful, and just plain wrong. I hope that this sentence gives you an insight of what we are doing and what we are trying to learn. We are trying to find useful and practical tools that can help us improve our trading strategies without an over-responsive indicator. Possible solutions could be Elliott wave theory, which was formed up about 80 years ago with the single author of Ralph Nelson Elliott, who has come up with the idea of so-called wave cycles. Here is a standard view on the complete market cycle according to Elliott wave theory. In general, the price movement is divided into two pieces. The first one is impulsive and or correction trend. To start with, we have a look at the principles of the wave theory. First, corrective trend always follows dominant trend. Second, wave 2 never retraces more than 100% of wave 1. Let's get back to 0, and then we distract second wave. As we can see, the wave number 2 should not go below the starting level of wave 1, otherwise it would indicate the start of a new trend. Third, wave 3 cannot be the shortest of waves 1, 3 or 5. In other words, above the impulse lines. This principle is confirmed on the standard chart. Wave 4 does not overlap price range wave 1 except from down. That means that wave 4 should stay above the top of wave 1. If it happens otherwise, it still could be a triangle. In the majority of cases, impulse trend or dominant trend consists of 5 pieces which are marked with numbers 1, 2, 3, 4, 5, and the correction trend consists from 3 parts which are marked with A, B, C letters. Let's have a look on the exact chart. Here is the example of United States dollar to Japanese yen on 4-hour time frame with the selected time of last. As I have marked on the chart, we can see a clear wave theory pattern. So we start with the first impulsive bullish wave, which is marked with red arrow, and it forms an impulsive wave 1. Then we descend in January 2015 to find the bottom and mark it with a wave 2. Top of is confirmed in more details a bit later. Third wave instructed in smaller waves as well. But after this, we see the confirmation of fourth waves below, which stays above the bottom of wave 3 price. Now let's concentrate on the price range of wave 3, as you can see that it consists itself from several parts as well. We mark it with lower numbers, but we can see that then the price has gone to the corrective phase, which has completed in the beginning of February, and then accelerated to the third part of the wave. After a minor correction, the third wave is the fifth part, which we mark with final number 3. Let's see what insights this template gives us to in real trading. I turn now to the live chart of USD to Japanese yen and choose a bit different time to picture. As you may recognize, we have stopped after the wave 4 was formed, and as we have seen a confirmed correction, the thing that we were expecting is the appearance of wave number 5. As we can see, in the time period it was formed with the current high of 125.85. We could learn from the Elliott wave theory right at the price range of 118.50 that there should be the other wave to the upside coming. Now is depicted another example of euro to United States dollar. We analyze the uh, letter development on 4-hour time frame as well, but the chosen time period is just the letter months. That means the June of 2015. The price has descended from the local top of 114.30 to the first descending wave or bearish wave, which consists of 5 parts. As we learn from Elliott wave theory, 5-part pattern is the primary indication. So what we expect is the form up of a wave 2, which stays below the previous stop. This is how it happens. have restarted. I have restarted the sound. Can you see? Can you hear me now? Okay, if it's fine now, then I continue. What was the moment the sound was in? Can you remind me, please? So once you hear me, we can continue, okay? Agree. So back to the chart. So the first opportunity is that we see a continuation of descendant dominant trend, but if the price gets above 1.1120, it will be the first indication that the current layout of bearish trend is wrong, and we probably see a following breakup of the previous top of 1.1277. That would be a confirmation of creating a new dominant trend in the direction to the upside. Now I'm switching the charts. Please let me know if you are keen to analyze any certain currency pair which you are specifically interested in. By now I will get into a few more details about United States dollar to Japanese yen, and then we can turn to a different instrument, okay? So I already see some things for it. We'll definitely return to that. In our first sample, we were analyzing United States dollar to Japanese yen on 4-hour time frame. Now let us go into a bit more details and see how can we implement wave theory on different time frames. So we start with the recent year top of 5th of June at the point of 125.85. I have marked the first descending line from the top 125.85 to the bottom of 18th of June 122.55. As you may see, this first descending wave consists of 5 different parts. The first one finishes on 9th of June. Third wave starts on 10th of June and finishes very quickly. And the final 5th part of the wave is just slightly below the minimum level of third part. Anyway, the confirmed setup 5 parts, and this is the primary indication that the following that the price will follow further bottoms. As you may see, it turned out to be true. The correction trend second wave has taken the form of 3 parts. As you may see, this is part A, then it is part B, and here it finishes at point 124.35, which marks the top of wave 2 and the start of wave 3. Let's make a zoom in. Now we have in the left corner of the screen the start of wave number 3. Let me adjust the scale. In case you have got any questions, please let me know. I will try to answer them. So, wave number 3 starts at 24th of June and finishes on the last day of June. Again, it has 5 parts. The third part consists of Sunday gap, basically. But anyway, this works as well. After that, we again have ABC model of correction phase. And finally, our recent development on the USDGI concerns the fifth part of the trend line. In order to get a detailed view on the fifth part of the descendant wave and understand the prospects of movement, let's get to intraday chart. So now we have the scaled version of fifth wave, which helps us to understand how what price can we expect further. Now I make a notation together with you. We point out the first part of wave number 5. It is, I point out like this. The correction is rather simple and basic. The correction finishes at point 123.18. Here we go with the third part of the downtrend, which is clearly longer than the first part. So this is a confirmed scenario. As we remember, third part should not be the shortest one. Wave number 4 stays here. So this gives us an understanding from 6 of them. That means that from today's Monday, the fall of the pair is connected with the development of the final fifth part of wave number 5. It distracts in following parts. First, we have a 5-part impulse wave 1, which stopped 122 exactly. Then the third wave is created from the 122.65 to the current point of 121.30, and still we see a continuing decline. Probably we are going to have one more leg down. So if, for example, you are holding short, this will be an indication for you that the short position should not be over yet, and we can expect one more leg down. Now let's try to understand what could be the right exit point for such a trade. In order to understand it, we use a different part of the trading principles, in particular dynamic levels. I want to remind you of the ascending trend line on the daily chart, which starts from the bottom of 13th of June 2013 and goes through the level of 8th of August with low 95.80. As you may see, this line, which is now selected in red color, has given us exact dynamic support in the time period of April and May, just 2 months ago. As you may see on daily chart, the price is approaching its current level. Let me make it precise with the information window. So the correct number for today of this trend line is 120.98. For tomorrow it will be 121.03. Basically 100.21 price is the dynamic support level that we can use in line with wave theory back to the in chart that suggests us that we may expect one more leg down as the probable exit case for the short trade, or on the other hand, an entry level for the long trade. That is the example for USD GPY. I will make a short note for you. Please let me know if you want some further explanation on USD GPY. Now I'm preparing to load Australian dollar to United States dollar chart. Unfortunately, I cannot comment on DEX as I'm mainly concentrated on trading currencies only, but will try to make a proper comment on the Australian dollar instrument. What I suggest, starting with the common time frame of weekly chart. As you may see, we are developing from the July of 2011 in the downtrend. Let's mark it up as a downtrend. And here we go. We are starting to find out the wave patterns. In order to make it clear, we see extreme levels. The first extreme level is the bottom of October 2011 at 0.9386. A clearly visible following top is based on the in March or the February 2012 with the high of 1.0856. This is the second wave. Now we can see few lines. I will mark it X with different color, so you see the difference clearly. Here we go like this. This is X, and this is X. This is X. This is X. This is X. So here are clearly 5 parts of the namely wave 3. This is first part, second part, third part, a shorter fourth part, and the very short part. We go with the further studies and use Fibonacci line to confirm the correction phase. We may see that the price has reversed just at the point of 38.2% of the trade, but I guess we get closer to this explanation a bit later in our next webinar. After this, we see a continuing downtrend. Here could be 2 different opportunities. The first opportunity is that wave number 3 finishes at this point. That means it finishes on the bottom of January 2014, 0.8660, and after this we see the continuation of descent. From the other point of view, there are just 2 more descending waves here in April, and the final one is expanding right now, probably with a target of 0.7260, and that can be the case of the extended 5th part of the wave. So we put the X down from here, and we mark it as a smaller number 1. Then it will be 2, 3, 4, and only then. If the assumption is right, we will have an extended descendant third line, which would be stopped around static support 0.7260, and starts in February 2012 at 1.0656. And if this assumption is right, we may expect major correction in the direction of trend line 0.94 in the course of coming several months or even years. What is your expectation on the Australian dollar? Are you trading with the expectation of some reversal in it as well? Or do you expect continuing downtrend? Great, Alfie. And do you have any certain point of reversal already? Okay. In your trading strategy, what could be a signal for reversal for you? Okay, so you're looking for support. Do you agree with my view on support of 0.7260, or do you see any other support? Okay, so you're expecting 74.20. As you may see, we have already come over it. Yeah, it definitely goes below. So, have you got any idea about 0.7260 level? If you want to, I can show you how I have come up with this level. This is a great example of a static level that we were describing last time. I'm not sure if you were attending our previous webinar. So on a weekly chart, you scroll back to December 2005, and you see that this level, 7260, was triple bottom as a static level until June of 2006. And then again, this level worked as a reversal in January 2009. So this is how we have come up with the static level. And very likely that this time it will work as a static support level as well. Let's see how it works in the near time future. So, time for a short conclusion. Have introduced to you that Elliott wave theory allows us to recognize current trend in the market and adjust the entry and exit levels appropriately. As a further studies, I invite you for our next webinar, which will be focusing on Fibonacci tools, so in particular Fibonacci retracement tools. They empower the initial wave theory and make it more precise because they help us to identify which correction trends can be counted as confirmed and which are not confirmed yet. When it comes to trading, it's vital to understand that trading conditions are playing one of the most important roles in our success. Otherwise, different trading strategies are not playing well without fine trading opportunities. First of all, we all know that the better the spread is, the less expenses you are going to incur. With Tickmill, you can get spread starting from as low as 0 pips. Secondly, you will never get a requote with trading a Tickmill. In addition to this, as Forex is quite volatile, it is important to choose a broker that executes your orders at the best available. This is what Tickmill makes available with the ECN system. Another advantage of Tickmill is that you will not have to worry about the security of your funds, as Tickmill keeps your account balances on the segregated accounts apart from its own capital. I hope that you found this webinar useful for you. I thank you for the attention, and I hope to see you in our next session, which will be dedicated to Fibonacci theory. Have a nice day and good luck with your trading.